Hello, everyone. Welcome to Ask the Planman. Everything you wanted to know about finance, insurance, and more, but were afraid to ask. I'm your host, Bruce Weinstein, and I have a belief that everyone should have a plan. Whether it's a financial plan, a retirement plan, business plan, a fitness plan, even a travel plan. Do you know that people spend more time planning their vacations every year than they do for their retirement? We're going to put an end to that. Each week, we're bringing you different topics to help you maximize your plans. Today, we're joined by Joseph Bensmihen, affectionately known as JB, my man. He has been a leader in the home healthcare industry for over 20 years. He currently serves as Director of Business Development for Visiting Angels of South Florida, national home healthcare provider with over 650 offices nationwide. Before joining this national provider, JB served as President and Chief Executive of Boca Home Care Services, a Medicare certified and private duty company serving Dade, Broward, and Palm Beach counties here in Florida. From 2006 to 2012, JB served as president of the Private Care Association, a national trade association advocating for standards of care for both caregivers and consumers who want the choice of consumer-directed private duty home care. As you can guess, we're going to be talking about long-term care and the impacts it's having on our seniors today. Under his leadership, he established the PCA. What does PCA mean?
Private Care Association.
Sorry, I didn't pick that up. He established the Private Care Association, thank you, as home care policy experts and lobbied Congress for benefits of caregivers and the elderly who utilize their services. He's also expanded their membership by 110%, adding national change such as Visiting Angels to its roles. For the last 27 years, JB has served as professional court-appointed guardian, advocating for the elderly and disabled throughout the state of Florida. In 2018, JB published his first book titled Taking Your Place at the Table, The Art of Refusing to be an Outsider. This book is a task-oriented work on how to serve as your own advocate in any situation. JB, that's quite a resume. I want to get into our topics for our audience today. Please welcome to the Planman. Tell everybody how you got started in the long-term care industry.
Sure. So I'm a social worker by profession, and in the year 2000 is really when I made my mark. There was a president named Bill Clinton who decided that no one should pay retail. The government shouldn't have to pay for everyone's care at a retail price. And so when you were getting Medicare home health services delivered to your home, skilled services, and Medicare was paying at 100%, the government said we can't balance a budget that way, and so we're going to pay on a capitated basis. The problem was that up until President Clinton had done that, people were getting visiting nurses all the time to their home, paid for by Medicare at 100%, and that was a flawed system, so people had to rely on hiring individuals privately. So once that happened, I got into the private duty in-home care services. I had begun earlier, but it really took off once the government balanced the budget.
Sure, there was a vacuum created where these services and needs had to be filled because the government wasn't going to pay for it anymore, so private providers had to become...
Right, it was the beginning. The government never paid for non-skilled care, but because you had your visiting nurse coming in to visit you daily or twice a day for skilled services like medication checks and so on and so forth, people kind of figured out a way they had a visiting friend visit them once a day. Once that stopped, there was a gap and people began to utilize long-term care insurance and the services of private caregivers a lot more.
So our show is Ask the Planman, and we want to give everybody a plan of attack when it comes to this. So I've been doing long-term care planning with my clients since the mid-90s, put a lot of clients in various programs for long-term care coverage. So let's break down for the listener what the 3 levels of care provision is in the space, and then how each of those are provided their varying services. So we've got custodial care, we've got assisted living, and then we have what's called skilled care. So let's break that down for everybody.
Sure. So if I may, let me start backwards. Let me start with the skilled care. So the skilled care is what you hope or you think your health insurance coverage will pay for. And that is, it pays for physical therapy, speech therapy, occupational therapy, and nursing. It means there's a skill attached to the service, right? Assisted living is when you choose to realize that you might need help to secure your socialization. You're at home by yourself, and if you had a building that would protect you, meaning you'd have services available to you within a building like a resort or a hotel type of atmosphere, would allow you to become more independent. And then custodial care, I like to say, is where someone is at home, needs help, right? And they need help 10% of the time to be independent and the other 90%. And it usually happens because of an episode. They broke a hip, or they're now living on their own for a variety of reasons, and their children live out of state, and so they need that extra help to allow them to maximize their independence. That is a misnomer. The government, your health insurance policy, nor the government, Medicare or your health insurance, does not cover custodial care and does not cover assisted living care. You have to plan to have money to pay for those two.
So in the epicenter of all of this, again, we want to give the people some of the education here, is we have what's called activities of daily living. Can you bathe yourself? Can you dress yourself? Can you clean up after yourself? Can you literally do the dishes, right? And so there's 6 activities of daily living, and then depending on your severity of the situation, and if you have insurance, you usually need to be, let's say, deficient in 2 of the 6 to trigger a benefit. So if somebody's bought the insurance, whatever that insurance is, and we'll talk about that a little bit later on, some of the programs that are out there, but in order for the benefit to pay, life insurance, you have to die, right? That's pretty definitive. We kind of know what life insurance is. So a lot of people don't understand, well, if I buy long-term care insurance, how am I going to get paid and who's going to decide? So it's basically your own doctor has said that JB can no longer blank and blank, whatever that is. Or on an extreme level, mental capacity diminishment, Alzheimer's, dementia type of thing. So cognitive in the brain is an automatic trigger if they've been diagnosed with something like that, maybe like a Parkinson's. And then just normal activities of daily living. So as my 90-year-old grandmother was becoming a 90-year-old grandmother, she started to forget certain things. She would put the dishes in the laundry washing machine. She would be confused. Maybe her arthritis was getting worse. She couldn't dress herself. And certainly they didn't feel she was sturdy a foot to bathe on her own at this point, in fear of falling. And so she becomes either what's called custodial care, where, as you said, somebody comes in to help a couple times a day, help her get dressed, help her with the meal, but they're not living with her. It's not round-the-clock care. It's just helping her get going in her day, checking in on her on a regular basis. That's a decision. And what I always talk with the clients on is money drives the machine. That's why you need to plan for this. So if you have the money to do the things, nobody ever needs to put you in a nursing home. Nobody ever has to throw away the key and lock you up into some place. If you want to stay home as long as possible, because most people do want to stay at home, especially if there's still a couple in place, one person doesn't want to leave the other person. They want to stay together. And so as they age and their health becomes the challenge, well, how does one 82-year-old take care of an 87-year-old? She's not going to be able to pick him up. She's not going to be able to put him in a bathtub. She's not going to be able to, wipe his behind, and so you're going to need that assistance. And so that's where you came in with your companies and you provided these home services, correct?
Correct. It's interesting what you said, Bruce, because it really has to do with planning, and people don't plan for this one piece. They understand maybe disability insurance. They definitely understand life insurance. Just to put a mathematical number on it, the average cost of care per day, and I'm keeping the numbers really, really simple. It's not even true, but meaning these numbers are numbers from the year 2005. Let's assume that care is $150 a day to have someone in your home care for you, right? 150 times 30 is $4,500. If you plan accordingly, if you buy a policy for $4,500 a year, right, you could get care depending on how it's planned for 3, 4, 5, maybe even 6 years to cover you. And so 1 month of care can cover you literally for 6 years if you plan it correctly. Every plan is different, and I'm not here to sell plans. But the piece that is very important is to realize that is the engine. Like you said, the money is the engine. I'll give you an active case that I have right now where a person bought a long-term care insurance plan but it wasn't a traditional plan, which is why it's very important to speak to an advisor that knows about insurances, because they bought it basically what I would call a bag of money to be used any way they want to use for long-term care. So this gentleman, who's now 87 years old and is living in a skilled nursing facility, so Medicare, right, and through an elder law attorney, he qualified for Medicaid, and so he now has his care covered in the facility, right? He has a bag of money that says you could use for home care, but it doesn't actually. A home, the way this policy is defined, is wherever you decide home is. So we were able to make the argument to the long-term care insurance carrier that they have to pay for his care, and we won, at Manor Care in the skilled facility. So again, the planning is the engine. If you do that, you can have a lot of money and be able to have a policy for care, because the skilled care is not covered. It's just not a covered expense, correct? Skilled care is covered by Medicare, not the custodial piece, not having a caregiver. So this caregiver literally takes him to the beach and is there to help him take a shower. So if there's 3 or 4 home health aides on the floor, right, he doesn't have to worry about that because he's got his own caregiver to care for him in the building.
All right, but let me jump on one piece. So let's be clear for the listener out there. Medicare, you have to be over the age of 65 to qualify for Medicare. Medicare will cover up to 100 days of a skilled nursing home situation. Okay? If you go through a hospital, let's say I had a stroke, God forbid, I had a stroke. I'm in the hospital for a few days, I'm stabilized, I'm not in threat of having another stroke that they could tell, but I need rehabilitation at this point. I'm not ready to go home, my wife can't handle me, and so they send me to a skilled nursing unit of some kind. The next 20 days, Medicare will pay for that care 100%. On day 21, I now have some financial responsibility. I believe it's about $194 a day. That's my co-insurance. And then anything after that, Medicare is going to pick up. So if it's $400 a day, I'm paying virtually half of that. After the 100th day, Medicare stops paying. So I know you're saying they're paying for it, but I don't want people to misunderstand. They're not paying for it in perpetuity. They're paying for it for about 3.5 months. After that, if somebody is still requiring that kind of care, again, let's use the more extreme of a Parkinson's, Alzheimer's, dementia person, they're never going home. They're going to need somebody to take care of them. And whether it's round-the-clock care in their own home or they're in some facility of some kind with round-the-clock care, the dime is being spent by the family, not Medicare, right? So I just want to be careful that we break that down.
Absolutely. And also, you could use your Medicare benefits, like if God forbid you have a stroke and then you rehabilitate, you go home, and then three years later you break a hip, you can still utilize your Medicare benefit again for as long as you didn't use those 100 days. If you use those 100 days, then your skilled care, they're done. They're per lifetime. The average person who plans correctly has Medicare as their best health insurance plan with a supplemental insurance, right, for their skilled care, and has a long-term care insurance policy for what Medicare doesn't cover. I would say now in our industry, I'd say 80%, 8 out of 10 people that we see, their care is paid for through long-term care insurance. People have begun to realize that it's a lot more cost-effective to buy the policy in advance.
So, as I mentioned earlier, I started doing this in the mid-90s, 94, 95, and it became a very strong part of the conversation with any client that was approaching the age of 50. And people say, well, why do I want to buy it so early? Well, there's a couple of reasons. Like anything with insurance, you have to be insurable. If you wait till you're 67 and you've got tremors and early onset of Parkinson's, you're not going to get long-term care. You need to do it when you're fairly young and healthy. So 50 is that magic age that we would talk to people about. Secondarily, a 50-year-old should be in a better financial position where the mortgage is coming to an end, the kids may be out of college, their cash flow has changed, and so those dollars tend to be freed up that they could apply towards it, or will transition people from their disability insurance over into long-term care for the back-end planning. So again, the planning and the plan man is you need to plan this out. So what we do in the financial planning process is we look at what's called your X factor, JB, meaning where are you getting resources for your retirement income from? Pension, Social Security, and your nest egg. And then as time goes by, inflation is knocking at your nest egg more and more. And so the biggest fear that retirees have is what? It's running out of money. And why would you run out of money? Well, because I'm looking at, you used $150 a day. Good luck finding a place, facility doesn't exist. It's at least $300 a day now. We're talking $120 to $150,000 a year expense. The average stay, and it's an average, I'm putting air quotes for the listener, not the visual YouTube watcher, is the average is 3 years. So you need to plan for at least 3, but what if you're in there for 7? What if you're in there for 17? I've had clients that their mothers got ill in their early 60s with a form of dementia. She needed to be institutionalized, and she lived for well over 15 years. So it doesn't always going to be an 87-year-old that's got, a half an hour left to go. It could be somebody that's younger, and they're going to need these services. So it is a financial disruption to your nest egg. If you have, I call it the rainy day. When I do my seminars, we talk about that rainy day. So everybody wants to have money put aside for the rainy day. Well, what is the rainy day? It's your health. It's your health diminishing. You get older and parts are very expensive to replace. I need a new valve. I need a new kidney, whatever it is. And so as your brain deteriorates and your function and motor skills deteriorate, you're going to need some form of care. Well, how are you getting it and how are you paying for it? Let's share a little bit about Medicaid, because I want people to understand that it's not really all it's made out to be where people are using it. You've got some experience there. So let's talk about what Medicaid is and isn't and break that down for the listener.
So the best way to remember the two, Medicare, you care for the elderly or disabled. It's skilled care, physical therapy, speech therapy, occupational therapy, right? And Medicaid, you aid the poor, right? So the question is, how do you become poor? So there's a variety of reasons, but one of them is you have less money than what something costs for you to have to make yourself whole. So if you, on average, I don't want to be quoted on numbers because I'm not a Medicaid expert in terms of the financial piece, but in terms of the delivery of care, like children, babies, right? Every pediatrician takes Medicaid. Because a child is born, it's not a fault of their own if their parents have money or not. And so every pediatrician takes a payer source so children can have a healthy life. As you get older, right, and let's jump to either becoming disabled or being elderly, right, you need a payer source to pay for care. So in our world of the elderly or disabled, there's two ways to qualify for Medicaid. It's the state paying for, if there's no other resources. Medicaid is known as the payer of last resort. So if you're a veteran, you're going to go into that bucket. If you're a Medicare recipient, you're going to go into that bucket. If you're a veteran with no Medicare, then Medicaid will step in. If you're neither, it is the payer of last resort. In order to be the payer of last resort, the belief is that you're poor. Now, it's as Fiddler on the Roof says, right? Tevye and Fiddler on the Roof says, it's no crime to be poor. Right? There's nothing wrong with being poor, but it's an asset test that you have to meet. It's for a different conversation. I don't want to confuse the listener. There are reasons why someone may qualify even if they have some money, but that is a whole different conversation that I don't want to bring the listener to that. For the average individual, they should realize that the state of Florida, Medicaid and Medicare does not pay for long-term care if you want to remain in your own home.
Correct. So I'll break down a little bit from some experience we've had on the Medicaid side, and again, hopefully give people some clarity on this. So, in a simple word, it's welfare for seniors, right? You are in financial distress, and there's money that can be provided. So the hard numbers are $2,000 for a single individual. So you have to spend your assets down or exhaust your assets to $2,000 or less. So if you've got $100,000 sitting in the bank, a portfolio, a 401k, you're not going to be eligible until you spend it all the way down, which is going to be very disruptive to somebody who doesn't have a lot of money to watch what they do have disappear. But now once you get to the $2,000 level or below, you are able to apply and in all likelihood will get Medicaid. Now, if you get a pension, if you get Social Security, you can expect that those dollars are going to be directed towards the facility that you are going to. They want to recapture that money and apply it towards your care. So if you get $2,000 from that and your care is $5,000, well, they're going to pay the difference. Okay. Now, let's be clear. We talked about the difference of planning and having money is you're not going to get the Taj Mahal Medicaid bed with private duty nurse and, big fancy motel, hotel location. If you're Warren Buffett and you want to go to the south of France and have the most luxurious home healthcare living, nursing home facility for $10,000 a day because he's got Johnny Got Rocks, well, God bless whatever he wants to do with his money. He can't take it with him. So your quality of care, and that's what we talk about in the planning, is it has to do with the quality of care. Where do you want to be? Who do you want to make the decisions? If I'm on a Medicaid side of the equation, I have no say in where I'm going and how my care is going to be administered. But if I'm paying the bill, then I get to pick and I get to shop. And that's where we want to give people the control of some of this. So I wanted to give a scenario here with some of the people that I've seen where they're trying to get rid of assets to get their elderly parent qualified. And this was a call I had just the other day, somebody up in Tampa, Florida, and they said that the couple was going to have the mother move in with them and that she was applying for Medicaid and maybe she was even on Medicaid at this point, and she had her home. And they wanted to sell the home to be able to buy a bigger home. They're going to take mom's money and add it to theirs, and they were going to buy, let's say, a dual family house or something where the mother can come with them. But the point is, they were triggering the sale of the house. And I want to emphasize this as a so what for the listener is, they can't force the parent to sell their home. If they're going to a facility of some kind and they don't have any money, they can't force you to sell the house to pay for the care first, because there's always the expectation, well, JB might get better and he can go home. So they don't force anybody. What they do these days is they attach that asset and at death will look to recapture the net proceeds when that house is sold. But in this particular couple's case, mom was already getting Medicaid. She didn't have a lot of assets. She just had a home. It doesn't matter what the value of the home is, JB. It could have been $80,000. It could have been $800,000. Doesn't matter. They can't force her to sell it nor take out a home equity line or go get a reverse mortgage. Okay, but they can attach, hey, we're spending $60,000 a year for her, and 3 years you owe us $180,000.
Only, Bruce. I mean, I'm not a lawyer, so I want to be very careful. However, the home is exempt as long as it's left the way it is. Only if they sell it, while she's on right. If they don't sell the home is exempt.
Correct.
And yeah.
So the mistake they were leaning towards, and I'm glad that they called, is I said, well, you don't want to sell this house. I said, you're going to trigger the sale, which is going to free up the asset.
You're going to lose the exemption.
That's right. And mom's going to lose her Medicaid eligibility, and then whatever that equity was, $50,000, you're going to be asked to spend it down till she's down to $2,000. So that's not the move for that particular client. So
but you bring up an excellent point. So that's, someone called you and you were able to give them the answer. I can't emphasize enough to the listener. There are so many of these that you think, well, someone at the pool told me this, and someone at the grocery store told me that, and my friend. Forget all that. Really, you should ask the expert, and the expert could be whoever they think the expert is. But I will guarantee you that either if someone sells long-term care insurance and has been doing it since 1994, 95, 96, that means they're up with the times of what's covered and what's not. If someone's been doing home health care since 1998, it means they're up with the times of what something really costs and doesn't cost. It's very important to find your expert and ask them. The only dumb question is the one you don't ask. So people should ask away.
And as we always say, you don't know what you don't know, so how do you know to ask for it? So part of our counseling is
ask.
But it's also to tell. It's to make sure they know what they don't know and give them that education. And that's what the Plan Man's trying to do, is help people self-educate. And then if they need more guidance, they can reach out to a professional. They can reach out to us or you or anybody else out there. So that's the format of the Plan Man. So, all right, so we touched on Medicare, we touched on Medicaid, we got activities of daily living, we got assisted, skilled, and custodial. The only item I had left on my list here is to talk about ccrcs, but did you have anything else you want before we hit up that one?
I don't. I would just caution that you can always fix something if you ask in advance. Right. The best example I'll give, and it has nothing to do with the elderly, but it has more to do with, I serve on a college board, and someone once said to me, "Oh, my son or daughter got a rejection letter, and I wish and I say to them, why don't you tell me that they applied?" And I can't guarantee that it's going to make a difference in the admissions process, but once someone makes their decision, it's hard for me as a member of the college board to convince admissions to change that decision. Same is true here. Before you get a decision or a denial on some kind of form of long-term care, speak to someone, because you can always fix something before the mistake is made. And so that is something that I just have to emphasize as best as I can.
I mean, the one word, no, it's great. It's a great point. The word you're using and alluding to is proactivity. Is we're proactive, we're not reactive. We don't want our clients to be in a reactive position. Everything we do as advisors is to proactively have them look at the what ifs. What if this? What if this? What if this? How do you want that to play out? Have you given thought to this? So I'm a mudslinger, right? I'm throwing mud at the wall. I've been counseling hundreds, if not thousands of clients in my 35 years. I've seen a lot. I can't say I've seen it all, but I've seen a lot. And so I have that experience to say, JB, this is what I saw happen here. If that happened to you, how would you like to see that play out? That's all I can do, is I can ask you a scenario, and then you say to me, you know what? I'm not worried about that. My kids have money. They'll take care of me. Okay, it's a choice. It's a choice. At least we know that's your game plan. And if that's how you want it to play out. Now, how many people have say, I don't want to be a burden on my kids. I had to take care of my elderly parents. They didn't have 2 nickels. I don't want to have that fall on my kids' shoulders. That's my best client. Somebody who's experienced it. And I always say I have nothing to sell, just problems to solve. So I wasn't a hard sell. But the easiest sale I ever had was somebody who came in having just dealt with or currently dealing with an elderly person situation, because that emotional impact on them was like, I don't want this to ever happen to my people. I don't want my kids to deal with this. I don't want my grandkids to see me like that. I don't want to be living in the street in a cart. Like, I need care. And so
I was going to add, and also, it doesn't help when people say, well, it's not right. My mother needs care. My father needs care. Medicare should pay for it. I, as a home care provider, cannot work on what the government should pay for. That's a public policy issue. If you want to fix that, run for office and change that. On a day-to-day life, right, I can only work with the reality of what we have. And the reality of what we have is that if you want to care for your mother and father, and I'm telling you that your insurance, your health insurance, whether it's Medicare or any other kind of insurance, doesn't pay for it, right, then you need to plan in advance. If you fail to plan, you plan to fail. And that's why this information is so important.
I've heard that line before.
Pray for me.
It's been my email signature for about 30
there you
years.
Go. Oh, there you go.
So the last piece to tie into people may be familiar with, and what I want to do before we part ways is talk about some of the transitions in the space that I've seen, and what type of programs are available on the insurance side. But the fourth piece of this, and it's kind of a hybrid of what we've talked about, is the ccrc, community care retirement communities. And my dad and stepmother have moved into them a few years ago. And what it basically is, it's a living community. It's not quite assisted living, but it kind of is assisted living. But you have to come into these things healthy. They are not looking for people who are already requiring the levels of skilled care. And there's a method to their madness, and it's an actuarial thing where they're trying to figure out, well, you buy in, you have monthly dues, but you're guaranteed lifetime care. And these facilities have been built by a lot of the hotel chains. So they're into the hospitality side of things. They understand how to run a cooking, catering hall. They've got movie theaters, and they do shows. But what it is, it's social. And so you have a reason to get up every day because there's breakfast and there's dinner provided. And so guess what the biggest growth population in my dad's facility is people over the age of 100. Every day somebody in the facility, and it's not like they got 1 million people living there, but somebody's turning 100. Now, the reason is that person has a purpose to get up every day. They don't live at home. They're not necessarily requiring all kinds of care, but they want to see JB for breakfast. We're going to play canasta. We're going to go to the movies. We're going to go to the bowling alley. We're going to go to the gym. We're going to go for a walk, whatever it is. So just like you see the over 55 communities becoming popular with pickleball and tennis and golf, there's these facilities now that provide a community living where the person doesn't feel like they're on their own or they're in a nursing home, and it provides them all these extra services. And again, it's a way to protect yourself because down the hall or in the next wing is the skilled care, is the assisted living. So my father's 7 years older than my stepmother. So presumably my father's going to fail and, being older sooner, right? If it just head to head, male, female, and he's older. So as that time comes, whenever it may come, my stepmother doesn't have to get in her car in the snow and drive to the nursing home down the street 15 miles away. She can walk in an underground tunnel to the next building and see him in that wing if that's where he is now. And so that's what this stuff is providing people, is again another solution to how couples can stay together or an individual person when the time comes and get the care that they need and still be part of a community. So it's assisted living, but it's not quite assisted living.
Let me tell you of a live case that occurred many years ago, 2002. And we had a client who had a long-term care insurance policy, and the insurance company didn't want to pay because they lived in one of those communities that you're mentioning. And we argued successfully that that was their home. The community might have a skilled nursing facility, right? But there's no guarantee that they're going to end up there. The reason they chose this community is because the word I used in making the argument was it was the orbit of care. But that doesn't mean that I'm going to use that care, right? It's just like if I go to a medical practice that has all kinds of specialties, I only use the ones that I need. I am now living in an independent living place that allows me to get the benefits, and if in the future I need it, then I'll deal with that then.
But that's my home. I mean, in my dad's case, they sold their home. Their address of record is the facility. Nobody can argue that they don't own any other property. They don't own any real estate. This is where they live. So it's hard to make that argument of, well, this is not home.
It's even better. They planned in advance. So it's unlike a specific, let's say, assisted living facility that where the lines might be blurred, right? Because they provide some kind of other care. In the case that you're mentioning, those are if people can afford them and they plan for them, I would recommend them very highly.
Sure, and let's break down. So when my folks got to that age, we talked about and quoted insurance options and programs, and let's just say that they're not fans of insurance. And so they opted to self-insure and put money aside to buy into a facility that provided them that ongoing care. So instead of relying on an insurance company, making premiums, never knowing if they're going to need it, when they got to that point, they sold their real estate and they bought into this facility. Now, right, wrong, or indifferent, it's their option, but I can make the argument, well, I'm not going to inherit that money now because you gave it to the nursing home. But that's not their problem. And that's not part of my plan, is ever getting an inheritance, right? So everybody has to, whether you have kids, don't have kids, you have heirs, you don't have heirs, you have a partner or spouse or don't, you have to be proactive and make these decisions. What I want to bring us to a close on is the transition that I've seen on the insurance space of what was available in the 90s has become very unobtainable and expensive in the 2020s. And that is your traditional standalone long-term care coverage. What I would buy in the 90s, if my clients could afford it, the way I broke it down, JB, was there's Hyundai, there's Chevy, and there's Cadillac. They're all modes of transportation. Not everybody drives a Cadillac, and not everybody drives a Hyundai. And I'm not being disparaging on the car makers, but you get the point that there's a difference in a perception of prestige. So a nursing home policy, a long-term care policy that was a Cadillac, would have all the bells and whistles and give you absolute coverage and protection. But JB, you can't afford it. We did your budget. We looked at your X factor. Your financial plan says you can't afford that kind of premium. Well, the Chevy, this is where you're going to give up a couple of things, but we're going to still get you coverage. It may not be lifetime coverage. It might be 5 years coverage. It may not be a 5% cost of living increase. It might be a 3% cost of living increase, whatever. So there's parameters and pieces to change. And so eventually you have to shop to what people can afford, right? And if you can't afford that, well, then, of course, we've got your basic model to get to the train station and back, but it's not a Cadillac. And so what happened, and probably one of the biggest resistances I ever got in providing options in this is people are like, well, what if I die? Like, I paid all this, I'm 50, I paid this for 30 years and I died. And so all that money in essence is lost. And that is part of the equation. But now there are plans that have return of premiums. And what's really happened and evolved that I want to drive home on with people now is there's what's called hybrid products. And the hybrid product incorporates life insurance with the long-term care. And so what does that mean to JB? It means no matter what happens, somebody's getting paid. You're buying a bucket of money. You're buying a benefit, let's say $500,000. If you never go into the nursing home, your heirs are going to get the $500,000. You got your money out. You paid $10,000 a year for it for 20 years. You put in $200,000 and your family's getting $500,000. It was a good investment, right? However, let's say now you need long-term care. Well, out of that $500,000, we have what's called an accelerated benefit. Your activities of daily living have triggered, and on average, you're going to get about, in this case, 2% is $10,000. You're going to have 50 months of benefits. Well, JB, you don't last that long. You only last 12 months. There's 38 months that are still owed, $380,000. Where's that money going to go? It's going to go to your family. It's going to go to your heirs. Okay? So this is where the solutions sit. This is where you need to do your homework. You need to do planning and just ascertain what your course of action is. I'm not telling everybody to go out and buy insurance. I'm telling you to do your homework, have a conversation with your elderly parents if need be, or as your parents are aging, and certainly with your children as it's entering your realm, and make sure they understand what your desires and wishes are, and that you've taken care of things financially or not for them. Don't leave people in the dark with a surprise package of, oh boy, now who's paying for this? So that's not proactive, right, JB?
And I'll tell you, as the delivery of home care, we get the plans and we execute with putting the caregiver in the home. We don't look at the rest of the plan, and that's best suited for the insurance agent or the financial planner who created it. For us, it's just the payer source, and we'll do whatever the person wants. But I will tell you that we've seen in the market space that there aren't as many choices, so you have to become creative. I can't emphasize enough, there is no substitute for a long-term care insurance policy. The cost is cost prohibitive if it was out of pocket. The average cost of care today in Palm Beach County is approximately $24 an hour, $25 an hour.
For that home care person. Yeah, that's a lot of money. And it's hard to get talent, right? Everybody's having employment issues in a lot of service industries, and yours is no different. How can people get a hold of you? Visiting Angels is nationwide. I don't know if you benefit from people in Wisconsin or Iowa, doing things or outside of the jurisdiction, but how can people reach us?
I represent Broward and Palm Beach. If you send a case to anywhere in Broward and Palm Beach through our office, I personally, as Director of Business Development, get credit. However, if someone lives in St. Petersburg or Clearwater and they need care, we'll send it to them, of course. But yes, we are we're around the country. We're actually in Canada as well. But I'm in Broward and Palm Beach. That's my territory. And the best way to reach me, believe it or not, I'm going to give you my cell phone. That is the best way. And we have a phone number that someone can, and I'm going to give you the office number so that everyone has that number. But the best way to reach me is my cell phone, which is 561-289-9495. You can text or call, or you can call the office at 561-865-9040. And there's obviously some backup to answer the call. And you don't have to be sure why you're calling. Even if you're not sure, we'll walk you through it.
Come ask your questions. That's what we're here for. So I like to facilitate that things flow through us as much as possible. I'd like it to flow through you as much as possible. Even if you refer it out to somebody in your organization, I'd like to see them reach out to you as a follow-up. So JB's information will be in the show notes, so please check that out below. I'd like to thank my guest for joining us today. You've been listening to Ask the Plan Man, everything you want to know about finance, insurance, and more. JB and I need a favor. We need you to like, share, and subscribe this podcast. Share it with people you know that have or are approaching needs in the long-term care space. You can check out our podcast channels on Apple, Spotify, and 35 other places. Come to my YouTube page, Ask the Plan Man. I'd love to hear from you. We want to keep bringing you more topics like this. Keep sending us your questions to bruce@asktheplanman.com. Visit my website, asktheplanman.com, www.asktheplanman.com. There's a theme here. Or call my toll-free number, 1-844-PLAN-MAN. JB, it was a pleasure having you. I think this is super informative. This is, the fastest growing demographic is the baby boomer. There are more and more there's 10,000 people a day turning 65 years of age. They are going to be booming into the long-term care needs. And at 65, unfortunately for some of them, it might be too late to proactively plan. So we want to get in front of people as early and as fast as possible. So remember, folks, if you need some advice, always get it right. Come ask the Plan Man. Thanks for joining us. Until next time, JB, thank you so much for being with us today. Everybody have a great day.